are live at the Barron Investments Conference at Lincoln Center in New York City. One of the companies in the Barron Fund's portfolio is Brookfield Asset Management, which recently bought a majority stake in Oaktree. Joining us right now is Bruce Flatt. He's the CEO of Brookfield Asset Management, which has about $500 billion in assets under management. Of course, our guest host, Ron Barron, who has been an investor in Brookfield since 2007. This is one of his long-term holdings. Bruce, thanks for joining us today. It's good to see you.
Thank you.
Let's talk a little bit about what you see in the environment out there, where you think the best opportunities are. What do you think is happening right now?
So I'd start off by just saying the macro situation is, there seems to be a shift going on in the world, and where in the last 12 months, we've seen where people thought interest rates were going up, and it appears that they're going to be down for a while. And irrespective, they were going to stay relatively low anyway, but we've just shifted the curve down. And what that means is that asset values in areas for real assets or tangible things that produce cash flow are going to be worth much, much more. And institutional investors globally really can't earn returns out of fixed income, and therefore being able to invest in those real assets with people like us who are doing it themselves is a very attractive way for them to earn the returns they need for their portfolios.
Ron, you agree with that perspective, right? You do think
yes. Yeah, Bruce was telling me a couple of weeks ago how he was financing a building in London for 70 bips. And so 70 bips. And so interest rates are extraordinary and extraordinarily low and extraordinarily attractive for a long period of time because there's so much uncertainty. And the economies in Europe are not doing very well. And the United States can't be the only country in the world with high rates. They have to come down also.
Right. So if you see real estate in London as an opportunity, what else do you see out there, Bruce, in this environment? If that's
look, our business is just buying globally, buying infrastructure, real estate, renewable power plants, and they all just generate cash. And we try to raise large sums of money, have the operations around the world, and then go to places where there's lack of capital. And one spot where, to pick one in the world, where there is very attractive opportunities because there is lack of capital for entrepreneurs and for businesses, and that's India. India is undergoing financial stress in their banking system today, and that generates opportunities. And the biggest thing that creates opportunity for real asset investors is being able to buy assets at less than what you would cost to build them or replace them. And that usually means that's the number one reason why you have a margin of safety on your side.
I remember talking to, years and years ago, the CEO of UTX at the time was George David, and he said he'd rather operate in China than in India because in India it was so difficult to get through all the different layers of government and all the bureaucracies. Has that changed over time?
Look, I'd say we like them both. Mm-hmm. They're both more complicated for a Western organization to operate in than you'd otherwise operate in, but they have different nuances. One is more difficult from a larger perspective, and India is more difficult from a micro perspective. But each one of them is extremely attractive. These are billion people markets. They're growing. People are getting richer. The middle class is getting larger. And what that means is there's opportunity. So we've been going slowly in those countries, but I think 20 years from now, we will have a much, much larger percentage of our business in both of those countries.
How has the risk perspective in China changed just over the last 2 years or even last year, given the tensions between our two countries?
We don't tend to think about the next year. We're investing, these projects we build or we buy and own, we own them for 2, 5, 10, 15, 20, 30, 50, 100, forever. Right. And therefore, what happens tomorrow morning isn't relevant. We need to find
what happens tomorrow morning may not be relevant, but if we are truly talking about a different paradigm relationship between the United States and China, where nationalistic tendencies get up, you see what happens with the NBA, with Apple, with other companies.
So we're a local investor in every country. Yeah. We go there, we bring money over the border. As long as it's a good country, we're a local investor. In each of the 35 countries we're in, we just invest locally. Trade doesn't really matter. Now, long-term, positive business conditions in a country are important, and therefore, if it changes the paradigm for that, then it it would matter. But other than that, we try to pick great countries and go there for long periods of time.
What describes a great country? Is it the booming economy,
No,
the demographics? What?
Rule of law, culture of respecting capital.
Well, I don't think China necessarily qualifies on either of those.
Culture of respecting capital, yes, they generally do. Size, where we can actually invest, and where we can operate with standards that we have to operate around the world. Mm-hmm. So we need to, and yes, you're right, China isn't as like the United States, but it's improving every year. And as I said, we've been slowly working into those markets.
Ron, what else do you like that you've heard ideas about places that you mentioned the 70 basis points in London in terms of being able to get capital for a building that they're putting into?
Wherever he goes, I go.
All right, so let's talk a little bit more about the infrastructure. That is a really interesting play. Because a lot of it's government money that's going to be put into these things too. What do you like there? Are there countries that you think are better prepared for that?
Here's what's happening. Governments are over-indebted, and that's even gotten worse over the last 10 years everywhere in the world because the money had to go from the banking system, the financial crisis, into governments. What that means is that they have to get money. Where big money gets spent in countries is in infrastructure, and you need to provide the services for people. Over the next 50 years, our prediction is virtually all infrastructure will move from government spending into private hands. Mm-hmm. And there is this enormous amount of capital that's sitting in sovereign plans and institutional clients, and it needs to earn 5, 6, 7, 8% return. They're all really happy with that. And that's what infrastructure is, transferring from governments into those institutional clients' hands.
You can make 8% return?
Yes, yeah.
So that's a great opportunity.
And sometimes better.
Wow, really? Bruce, want to thank you.
In California, by the way, the government CalPERS, they can't make 7%. So
no, I know. We had CalPERS on last week.
Yeah, they have to go and they have to take more private equity investments. And Bruce is positioned to provide ability for them to do that.
Private equity, what kind of returns do you anticipate getting over the next decade or two?
Our last 20 years of private equity returns have been circa 20%. Yeah. What I would say is, even though rates come down, and this is the great value what institutions see in real estate, private equity, infrastructure, renewables, all alternatives, is that the spread between what you can earn if people can do the work that we do, the spread you earn compared to treasuries is still very, very high. And as a result of that, they're very attractive in institutional client funds.
Bruce, I want to thank you for your time. It's really a pleasure.
Thank you for having me.